Welcome, everyone. Thanks for joining us today. I'm Glynis McClure, an Extension Educator and Farm and Ranch Management Analyst with the Center for Ag Profitability at the University of Nebraska-Lincoln. Find out more about the center as well as an up-to-date schedule of more webinars on our website at cap.unl.edu. Congress just passed the One Big Beautiful Bill Act, and it's packed with tax changes that could hit your farm's bottom line. From deductions and depreciation to how we plan for next year, there's a lot to chew on. Today, we're glad to be joined again by Tina Barrett, Executive Director of Nebraska Farm Business Incorporated. She will break down what matters, what doesn't, and what you should be thinking about now to stay ahead. Tina, as Director of Nebraska Farm Business Incorporated, works with hundreds of producers in the state to provide financial analysis, business planning, tax planning, and tax prep services. She began her career there after graduating from UNL with a degree in agricultural economics and has served as an executive director since 2002 with Nebraska Farm Business. Tina is also a part-time instructor in UNL's Department of Agricultural Economics, teaching farm accounting, analysis, and tax management to undergraduates. So we invite any questions that you may have today as we go through the webinar, and please use the Q&A feature on Zoom, which is in your panel there on the Zoom window. So we'll be watching the Q&A and try to have those questions answered as we go throughout with Tina. So thanks again, Tina, for joining us, and it's time now to turn it over to you. Thank you.
Sounds good. Thanks for having me. I've been spending most of the last month and a half or so digging through this, so always good to be able to share what I've been spending my time on. So, all right, so let's get started. So, like I said, the One Big Beautiful Bill. I wish they would come up with acronyms before they name the bills, because OBA just seems weird. But that's what we've been calling it in the office for short. But it was signed on July 4th, and it's 870 pages, so not a short read. And there's a lot of stuff in here. There's farm bill stuff, there's banking and transportation, Medicare change or Medicaid and Medicare changes, lots of things in addition to the tax stuff. But I'm going to focus on what I know, and that's the tax side of things. We do have to watch there are effective dates all over the place. Some at the beginning of the year, some January 19th, some July 4th, some 2026. So it's important that we pay attention to the effective dates on those. And then the other thing, well, I'll get to that here in just a second, but let's start with the income tax brackets. So that was the first thing. So a lot of these changes in this bill are extensions of the Tax Cuts and Jobs Act that we had back in it was actually passed in 17, but really it was right at the end and affected 2018. So almost a lot of things in the Tax Cuts and Jobs Act were set to sunset at the end of this year. So and again, that's all they do that for reasons to be able to pass a bill in the process that they use the reconciliation process to get zero-based changes, and so they can only make these cuts for so long. So anyway, we are back to having the 10% to 37% brackets that we've been used to since 2018, and this bill has made it permanent. And so we won't have to worry about a sunset coming up in the future. But I do want to make sure that we point out that just because this is permanent doesn't mean it's really permanent the way we would think about it. It only means it's permanent until Congress changes the law again. So it's different than a sunset where, this would have automatically reverted back to the old rules with a sunset. When it's a permanent law change, then Congress actually has to act to change it. So it feels a little bit better than when we have a sunset, but still, it's just good until they change their mind. So I had put this together last year when we were starting to anticipate that sunset coming, but I think it's interesting just to see where the tax rates have been. And I went back to 1981 because that was kind of, a big year. And at that time, incomes over 215,000 were being taxed at 70%. So that makes our 37% feel a lot better. I did index that for inflation just to see, so it would be similar to incomes of about 750,000 today. Anything over that was going 70% to the government. So that's pretty crazy rates. 86 was the prior to the Tax Cuts and Jobs Act was the biggest tax reform we'd seen, which had lowered those rates, but also still a lot of brackets. And then I have the 2017 ones again that it was going to revert back to, which would have had the highest bracket back to 39.6%. But the biggest thing that Tax Cuts and Jobs Act did to those brackets, so it was a little change, 15 went to 12 and the 25 went to 22, but they really expanded those brackets. So, before the Tax Cuts and Jobs Act, the highest bracket started at that, well, it would have been about 600,000 of income. And now that top bracket doesn't start till 730,000. So, it just, those brackets got a lot wider in addition to some of them actually dropping in percentage. So this is a good thing. Again, not going to notice the change since the law was passed. It would have been a very significant impact if it had not been extended. So, in addition, again, Tax Cuts and Jobs Act moved that standard deduction way up high. So it had been like 12,000 for married filing joint, and they significantly increased that. Again, the idea at that time was to simplify the tax code. So what this did was give everybody a higher standard deduction so that less people would need to itemize. And we definitely have seen that over the last 5 or 6 years, that we are just not seeing a lot of itemizing anymore, which is fine. That could change with some of the other things we've got to talk about here, but they did increase it so for a married filing joint couple, the 2025 standard deduction was going to be 30. They raised it to 31.5, and they raised the single from 15 to 15,750. So not a huge change, but this again was made permanent and indexed for inflation for every year. So because it was set to go back to those lower levels. So looks like this is our new normal going forward for the standard deduction as well. All right, so another thing that was put on hold actually in the Tax Cuts and Jobs Act was the personal exemption. So this is, we always talk about deducting kids and claiming dependents and those kinds of things. This took a lot of that out of the discussion because we no longer get this was like a $3,000 or $4,000 per person deduction. And again, it's another reason why that standard deduction got raised up so high. And so instead of trying to figure out, who, can claim, a child and when somebody's your dependent and all those kinds of things, they just kind of took this out. And then, but it was set to come back again in 2026. And then this new law, again, just permanently repealed that. So I don't think we'll probably see personal exemptions come back in into the tax code again. All right, so I said that itemized deductions have been significantly reduced. The other reason, besides the standard deduction being significantly higher, was that they put a limit on the deduction that you could take for state and local taxes. So this is a big deal in states like New York and California, but it's impactful for Nebraska as well. And what they did, and this is something that certainly was covered by a lot of the news media and different things, because it was significant in those high incomes or those high tax states. But the state and local tax deduction has been limited to $10,000. And that didn't matter if you were single or married filing joint or anything like that. Every tax return got $10,000. So what this bill did, this was a big compromise in getting enough votes to get this passed, is they raised that cap to 40,000 for the next few years. And this is, again, one that kicks in next year and goes through 2029. Okay, so it's not an issue for 2025 yet. And then, but we are back to a sunset on this one. So this one's not permanent. But that cap is going to increase 1% per year through 2029. So they'll add a little bit to that each year. The caveat or the trade-off is that if your income is more than 500,000. That's a modified adjusted gross income. So there's a calculation to that. It's going to start to phase out. And if your income is over 600, you're back to the $10,000 limit. Okay, so you're not going to get any less than 10,000. But they are working on that to keep high income, the real high income from utilizing this deduction. So, a big deal, and could be certainly impactful for next year as we talk about that. And that slide actually just repeats that, so we'll be good to go. All right. Just definitions again. SALT taxes are any state and local income tax or your state and local general sales tax. Again, for Nebraska, most people are going to be using the income tax. They put that sales tax in there for the states that don't have an income tax to make it something comparable or a fairness thing. But it does also include your real estate taxes on your personal residence and motor vehicle tax. So we got to be careful with that. It's not everything that costs you to license your vehicle, but the portion that's figured on the vehicle's value is something we can add to that. And so I also just went in 2026, the max rate for Nebraska income taxes is going to be 4.55%. So if you've got that $500,000 AGI, the total income taxes you would pay is 22,000. So if you're up to that 500, we're probably not going to be hitting that max 40,000, unless you got a lot of, real estate taxes, fairly significant personal real estate taxes. So, certainly something to pay attention to. And again, a reminder, I know this got confused a lot, when the Tax Cuts and Jobs Act came out, that this is Schedule A itemized deductions limit. This is not limiting the amount of real estate taxes or anything that you can deduct on your Schedule F. Those are business expenses, completely different. So not a concern on that one. The other itemized deduction change is that the Tax Cuts and Jobs Act did put a cap on mortgage interest deductions if the mortgage is more than $750,000. Again, I don't think we run into that. I don't know if I've ever run into that. But the One Big Beautiful Bill made this permanent as well. So again, any interest on loans larger than the 750,000, or you can only deduct up to the first $750,000 worth of the interest on that much principal, is going to be a permanent part of our tax law. And again, this is itemized deductions, does not apply to farmland interest or anything like that. We don't have to worry about interest caps there. So just on personal residences. Excuse me. All right. This is another, excuse me, deduction that's going to come into play in 2026. But if you remember back into 2020 and 2021, they gave us a charitable contribution donation deduction above the line, which basically means we don't have to itemize to get it. In 2020, it was like $300 that we could put on a return and deduct without itemizing. And then in 21, they raised that to $600 for a married filing joint couple. What the One Big Beautiful Bill did was bring that back and raised it up to $1,000 for an individual or $2,000 for a joint filer and made it permanent. So this is kind of a nice thing. Again, one of the concerns about people not itemizing was the potential that there was a lack of incentive to give to charitable organizations, and that would start to suffer. So there's kind of a nod to that we can take a little bit of a deduction without that. So we still have to follow all the documentation rules. If it's more than $250, there has to be a receipt from the charity that says no goods or services were received for this, and that has to be on file with the tax return, those kinds of things. But a nice little thing for those who are not donating enough to get to that itemized level, but are still doing some giving. So again, 2026, so that's a next year thing. A new this year thing is the return of the car loan interest. So this is again personal use vehicles, not talking about farm vehicles, but if you got a personal vehicle, we can go back to deducting car loan interest. Again, this is limited, so it's going to sunset in after 28. And they've put some pretty good rules on this. So there is a $10,000 limit on the interest. And if your income is more than 100,000 single or $200,000 joint, it will phase out. So once you get to 150 single and 250 joint, you're not going to get to use this. You do have to have it. It has to be a new loan starting this year. And it won't probably affect this year, but maybe by 28, you could refinance those loans as long as the vehicle is still qualifying. So let me give you the rules on what we've got to have. The vehicle has to be brand new, can't be a used car. The final assembly has to occur in the United States. I don't understand this law, but it specifically says it has to have at least 2 wheels. I don't know how many one-wheeled vehicles are out there. It has to have a primary use to be used on public streets, roads, and highways. So it's going to take a lot of utility vehicles and things like that would be used for personal use. And it has to have a gross vehicle weight of less than 14,000 pounds. So they're going to put together a list of all the qualifying vehicles that on a website called the VIN Decoder, and that one's going to be available. And so you can go and check and see if your car or if your personal vehicle is going to qualify for that. So that's any vehicle purchased after January 1. So anything in 25. So even before the bill was passed, that's eligible. And could be interesting. From my standpoint, the best thing is lenders are going to have to be required to report that interest. So even when I've got a farm pickup, that's always one of those ones that's hard to track down. And the lenders are going to be required to send that interest. So it's going to be really nice for my farm side of things too. So. Okay, maybe it was a long time ago. I'm thinking 80s, maybe early 90s, since we've been able to deduct any interest that wasn't on your personal residence. But this is kind of a throwback to an old law that did exist, but certainly got it narrowed down to wanting to make sure that we're encouraging purchases, for the vehicles made in the United States and some of those other law and not unicycles apparently. So. All right. This one's got a little bit of news as well, because it was certainly as close as we got to the campaign promise that there would be no tax on Social Security. So there's a lot of confusion that this is a deduction against Social Security income, but it is not that specific. So this comes into play for any person who is over 65 by the end of this year. So it is effective for 25. And it's 6,000 per person or 12,000 per qualifying couple. One thing that I haven't been able to understand, and some of the other experts that I've worked with we're not exactly sure if this is going to be an above AGI or a below AGI deduction. We do know you're not going to have to itemize to get it, so it's not that. The difference if it's above or below AGI is things like if it's above AGI and it lowers that, then that could lower actually how much of your Social Security is taxable or how much of your health your premium tax credit on your health insurance might be. So it could be a big deal. It looks to me they actually put it in the same place of the law as the personal exemptions were when they eliminated those, and they replaced it with this. So I'm thinking it's going to be below AGI and right by the standard deduction, but we'll have to wait until IRS gets those forms put together to know for sure. So again, 4 years of eligibility on this one. It could be interesting to see if this one gets extended or not. There is a phase out on this one as well. So if you're single and your income is above 75,000, they're going to start to reduce that. If it's above 175, you're not going to get it. Okay, and then the married filing joints are just double that. So, still a great deal, and it's going to be impactful for a lot of individuals over 65. The other thing that has come up on that is you certainly don't have to be taking Social Security to get that. So if you could be 65, not electing to receive Social Security, and you're still going to get that. So it's really not tied to Social Security income at all, other than there was a campaign promise, and this is as close as we got. So I just put this together to kind of put this to, so a standard deduction for a married couple in 25 is going to be the 31.5. If we take, we already have an additional standard deduction. If you're over the age of 65, that's 2,000 per person. So that still stays there, didn't go away. And then the bonus senior deduction of another 12,000 means a couple over age 65 can have 47,500 of income before they even pay $1 of income tax. So, it's a pretty good chunk of income there that we can have tax-free as a senior. So, all right. I will keep going here. So, one of the big pay-fors, right? So again, this was a reconciliation bill, so everything had to kind of balance out. So, one of the things that went was all the green energy credits. They were eliminated. So, we have until the end of the year to get the energy efficient windows, doors, HVAC, etc. So if you're going to make any of those improvements to your personal residence, get it done before the end of the year, and we've got some credits available. The residential clean energy, which is mostly I've seen used for geothermal units, also ends at the end of 25, so be careful with that one. There is some others that for commercial buildings and new homes credits that the construction as long as the construction starts before June 30th, and there's a deadline for when it has to be done too. But so if you need more information on that, I can look that up. But yeah, that one has a little bit longer. And then the quickest deadline is the clean vehicle credits. So for the plug-in electric vehicles, those have to be purchased before September 30th in order to qualify. So again, those things are just going away, but if those are on your radar of something you were going to take advantage of, should get that done soon. All right, another big campaign progress was no tax on tips. So this is again a phase out. It's not permanent. So we've got it from 25 to 28. You have to be in an industry that is traditionally and customarily receives tips. So I think they're going to watch this really close to make sure that this is used by waitresses, bartenders, Uber drivers, those kinds of things. We can't really come up with very good ways as to why farm workers would be traditionally and customarily receiving tips. So I don't think this is really going to apply to a lot of our farms. Your income does have to be under 150,000 single or 300,000 joint in order to take this deduction. The employers are going to have to report the occupation on the W-2 in addition to the tips. Tips are already reported on W-2, so that's not a problem, but they're going to have to list that occupation on there so that the tax preparer, and I assume we'll have to report that. Well, obviously the W-2 goes to IRS, so it's going to be a double check on that occupation confirmation there. Tips are still subject to Social Security and Medicare taxes, didn't get out of that. And so we've got that. So again, I don't think it's something that's going to affect a lot of farm clients, but it looks to be a Schedule 1 adjustment, so it will affect reduce your adjusted gross income and those kinds of things. But yeah, so no tax on tips. The other one is no tax on overtime. And they, again, were very specific and detailed in the requirements on this one. So this one you can deduct up to 12.5 if you're single and 25,000 if you're joint. Again, one thing that we're still kind of, it'll be interesting to see how IRS interprets it is if two spouses each can deduct 12.5 of their earnings, or if because you're married filing joint and one spouse has overtime pay, they can deduct 25,000. A fine little detail rule, but with that one, is just not clear in the law, so it will be IRS's interpretation of that. It's also not quite as great as it sounds. The only thing that you can exclude in your overtime is the extra pay. So if you normally get paid $20 an hour and your overtime rate is 30, you can only deduct the $10 of extra pay, as that it's only the $10 that starts to count towards your $12,000 limit. And so it takes a lot of overtime. We did some math that maybe like at a $50 an hour job, it's like 1,000 hours of overtime in order to max out that credit. So it has the same adjusted gross income phase outs as the tips. So if you make too much money, not going to get this deduction. And it clearly states in the law that the employee has to be covered by the Fair Labor Standards Act overtime rules, which farm workers are exempt from, which we've always liked because then we don't have to pay overtime to our farm workers. But even if you choose to pay overtime to your farm workers, because they are not covered by that Fair Labor Standards requirement, they are not eligible for the exemption on overtime. This one is going to have to be separately reported on the W-2. And so that one is going to be a little bit extra work, and they're going to have to get that W-2 reworked pretty quick to put both the occupation and this overtime requirement. The law also says that employers can choose a reasonable method for how to determine how much of their pay was overtime for 25, and then directed the Department of Treasury to give us good rules for 26 to 28. So pay attention to that as we get closer if this affects you, because if you have a trucking business or some other businesses that are subject to that Fair Labor Standards Act, even though majority of what you do is farming, we might still have some opportunity to help our employees that way. All right. Child tax credit. The Tax Cuts and Jobs Act increased the child tax credit from 1,000 to 2,000. Again, was going to sunset at the end of this year and go back to 1,000. And the One Big Beautiful Bill permanently increased that and went a step farther to 2,200 per child in 25. And then it's going to index for inflation starting after that. So again, we don't have any more phase outs or sunsets on this. And it will just start increasing just like a lot of the other things. Kept the refundable portion at 1,700. So if you don't have enough income tax owed to get the 2,200, you can get up to 1,700 of that back if all of the circumstances are correct. And the phase out remains at 200 for single and 400 for joint filers. So that again was an increase that was made with the Tax Cuts and Jobs Act, and now is permanently in the law. There was also at that time a $500 dependent tax credit. So the child tax credit works for anybody that's under the age of 17 on December 31st. This one takes over at that age and goes up until the child's no longer your dependent, and it's $500. And it was also set to go away, and they made it permanent with the One Big Beautiful Bill again. All right, another change they gave us was to help with the child and dependent care tax credit. This is a 26 one, so it's not going to affect our 25 returns. But maybe if you have option to, we'll talk about the dependent care flex spending account too. But if you're making that choice here at the end of the year with your employer, you might want to reevaluate that depending on your income. So this used to be a 35% max that you could take 35% of your daycare cost as a credit. They upped that to 50%, but your income has to be less than 15,000, which is where the 35% was too. So if your income's real low, the dependent care credit becomes really valuable. But even so, the max is still at 20%, but that used to kick in on any AGIs that were over 43% or 43,000. Now it doesn't kick in until your AGI is 150. So a lot more taxpayers are going to qualify for a larger credit than they did in the past. And so we can go, yeah. So I think it's going to be beneficial. Again, doesn't kick in until next year. Both parents have to have earned income to qualify. Those kinds of rules stay the same. And then they also increase the dependent care flex spending account. So this is something that you get from your employer. I think we could probably set some things up from a self-employed standpoint this way too, but that's a different day discussion. But it used to be 5,000 that you could put in there for your family, and now it's moved that up to 7,500. It's still pre-tax. So the benefit to this has always been that this one will reduce Social Security and Medicare taxes, where the dependent care credit won't. You can't get both. It's one or the other. This one still stays with the use it or lose it. So if you tell your employer to defer 7,500 of your income to this, and you only spend 6,000 on dependent care, the 1,500 is gone. So this one is permanent and starts in 26 as well. So we used to always say this one was better than the dependent care credit. There is going to be some income levels where the dependent care credit is now going to be better than this one, but we'll see how that goes. So as I see, I'm going to switch into business provision. So if there's some questions, it would be a good time to grab those quick. Maybe I lost. Let's see here.
There is one, Tina.
Yeah.
How does the employer report overtime that isn't taxed on the W-2, or will it be subject to state taxes?
Yeah. So actually, the employer is still going to report the entire amount of income just the same way. So box 1, box 3, box 5 of the W-2 are not going to be different. What we're going to do is on Schedule 1, take a deduction for the amount of overtime. So, and again, we think that's where that's going to get reported. If that is it, then the state of Nebraska uses the federal AGI to start. And so we should get that deduction from the state as well, unless the state decides to change something, next year, but they couldn't do it for 25. They would have to change their law in order to make that tax. So, so yeah, it looks to me like the employers, everything on the W-2 is going to look the same, except they're going to give us a little bit more information, and that we're going to take as a separate deduction. So hope that helps.
Thanks.
All right, let's get into some of the business stuff here then. Again, extensions, we got an extension of the qualified business income deduction. I think this would have been the biggest thing that would have hurt a lot to lose out of the Tax Cuts and Jobs Act. This gives sole proprietors and pass-through entities a 20% deduction for business income. And that's just what that does on a tax return is just huge. And the One Big Beautiful Bill made this permanent. There was some talk in the Senate version of increasing it up to 23%. That didn't make the final cut. So, but we are definitely at 20%. And then the other thing that they did was increase the income limits. There's a phase out on this as well. And it used to be a $50,000 phase out for single and $100 for married filing joint. And they increased that to 75 and 150. So it's going to be a little bit broader. And this is nice, but it's for farm operators. For most operations, we can get that limit extended because there's a special provision that allows us to use half of wages and 2.5% of our qualified investment to restore that, even basically to override that phase out. And so even a lot of our higher income farms don't actually see that phase out. So, and then they did also increase that, or they're going to index that for inflation so that those limits will go up as incomes do. The thing that's new is they added this minimum QBI deduction of $400. And so you have to have at least $1,000 of QBI, so qualified business income. This one I think is going to also be interesting as we get some more clarification on IRS as to how they're going to calculate this. Because if you have to have at least $1,000 of QBI, like net QBI, which I would think that they've only added $200 to this, but they wanted to have everybody get something meaningful. So, I don't know. We'll see how the regulations come out on this one. It's obviously not going to be a make it or break it. It's just going to be a nice thing if we got it. So, um, one of the things that I kind of thought we would get and didn't was any change on the business meal deduction. So if you remember back to the Tax Cuts and Jobs Act, they had made business meals, so meals that the employer provides for their convenience. Those kinds of meals were limited to 50%, and then after 2025 was going to zero. And there was no change to this unless you operate a fishing boat or a fish processing facility above a certain uh, line in the on the globe. So someone very specific got their meals restored, and everybody else is out. So starting January 1st, there will be no deduction for business meals that are there. This doesn't change travel meals. But this would be like if you were feeding your employees lunch at the kitchen table so that they could get back to work quickly, not going to be able to deduct those anymore after the first of the year. So, all right. Big depreciation changes. Again, little history, Tax Cuts and Jobs Act made bonus depreciation phase out. So we were getting 40% this year, 20% next year, and gone in 27. We are now fully restored to 100% for assets purchased after January 20th or 19th. And it's permanent. Okay, so we don't have to worry about these phase outs again. Again, this is going to apply to assets with a 20-year life or less. So that's going to be pretty much all farm assets, including machine sheds, which have not been, or any multi-purpose building have not been eligible for 179. So always been important to use bonus on that. Couple special rules for 25. If you bought an asset between January 1st and January 19th, you can only use the 40% bonus. Okay. Anything that was bought after January 19th through the end of the year, you can choose 40% bonus or 100% bonus. And it's not going to be per asset. It's going to be per tax return. So you're on your tax return, you can choose to use 40% bonus or 100% bonus. And so it'll be a interesting planning toggle as we move through that. They also added this qualified production property deduction. So this is new, haven't had this before, but they basically extended the bonus rules to production facilities. So these assets are maybe like if you're going to start making cheese, or you're going to start taking your farm products and making something else out of them to sell, this would apply to that. These are buildings that would normally have a life class of like 39 years, and now going to be eligible for bonus. So kind of cool. It is some specific rules that has to, construction has to start by 2028, has to be placed in service before 2020 or before 2031. That's almost hard to say, even though it's only 6 years away. And so again, something new, going to affect a very small number of people probably, but if that affects you, is certainly something you want to talk to your tax preparer about. All right, and then 179, we had the Tax Cuts and Jobs Act made the limits we had permanent, and again, lasted all of 5 years, but that's okay because they doubled how much we can deduct with 179. We were at 1.25 million for 2025. We're up to 2.5, And with 179, there is a purchase limit because this was always meant to be a small business tax deduction. So if you purchase more than $3.13 million worth of stuff, your purchase or your 179 eligibility would go down. They increased that to 4 million. So basically, as long as you're not buying more than $6.5 million worth of assets, 179 is on the table for you. If you purchase more than that, then it's not, but it really doesn't matter because when we just roll over to bonus and get our 100% deduction that way. So back to all kinds of flexibility for depreciation. The biggest thing is if you're going to have to use bonus, then that is a tax return election and by life class of the assets. And 179 gives us a lot more flexibility because we can elect any dollar amount up to that 2.5 million. And so both have their benefits, but either way, we're getting a lot of flexibility. So, all right, so let's talk about just some other general things that were in that bill. The estate and gift tax lifetime exemptions going to go up to 15 million. I love that they summarize this as jumps because it's at 13.99 million this year, so it's not really a huge jump to 15 next year. But that's 30 million per couple that can be passed through without any estate tax purposes or any estate taxes. And this is permanent and it's indexed for inflation. So this is really kind of a best of all worlds when it comes to the estate tax things. That's a lot of net worth that we can pass on to the next generation. And with some planning could be even higher than that. So lots of good stuff there. The tax rate stays at 40%. So anything over that 15 million per person would be taxed at a 40%. And they left that annual gift exclusion alone. So we're at 19,000 per person that you can gift in any one person in any year. And all the step up in basis rules remain intact. So, that's really the biggest benefit that we've got. And so all important things. All right. I almost hate to even discuss this one, but I put it in there because it is a significant change that they made. So the research and experimental expenses has been not new. It's been around for a while. What they changed in this. So in 2023 and 2024 and 2025, the rules that we were going to have what required if you took this credit, any expenses that were eligible for that helped calculate that credit, we had to take off of Schedule F and amortize it for 5 years. So we basically had to spread them out over 5 years. This retroactively says, hey, we can go back and now you can deduct those expenses and take the credit at the same time. The caveat in that is that the returns for 23 and 24 will have to be amended by July 4th of 2026. So it really doesn't give us a lot of time to talk to producers and get those amendments done while we're also processing the 25 return. So if this is something that you think affects you, it's probably best to talk to your tax preparer sooner rather than later, so we can get that done while there's time. We still have to follow all the same research rules. There's a 4-part test that can get very complicated, and those sorts of things. So this is like a really specific, very detailed law, but that not having to amortize those expenses is a really big difference. I do want to just point out that this has been flagged, IRS has flagged this credit in its Dirty Dozen campaign. So every year that IRS puts out what they say are the 12 biggest bad things done on tax returns, right? And so this is certainly there. The credit is in itself very legitimate, but there are a lot of people out there promoting this and making a lot of money off of calculating the credit and aren't always real careful about whether or not they're doing it correctly. So so be really careful. I just put this in here. Make sure that you're checking who's the professional is that is helping you calculate this. This is not an easy calculation. So it takes a lot of work on that. Make sure that you're understanding and that your tax preparer is understanding how they're determining that credit, and what they're all included in that. That we have to have everything documented in order for this credit to go through. So make sure that it's all in very explicitly written out and that everything's tied out. And it doesn't ever hurt to get a second opinion on stuff like this, because again, this is not something that anybody does well, other than outside of these firms, does every day. So it's certainly got a lot of things attached to it that we need to be really careful about.
Hey, Tina,
Yeah.
there is a question, and I think you just really touched upon it, though, that
Yep.
changes for the use of research and development tax credit for farmers.
Yeah.
So also, I mean, is there like an example you can give us of research and experimental expenses that you've seen come through on tax returns for farmers?
We have not done, we have a few that are in the works of going through some of that research and preparation, but we haven't actually done any. So the things to be really careful about is that your research, it should be research that's done to eliminate or reduce risk on your operation. So if there are some out there saying that if you change your seed variety across all of your acres, that's research and all of your seed is an eligible expense. I don't think that's probably true. I think, if you had a test plot on your farm and you were really looking at small, uh, parcels that were to, really see some of the differences in whether it's a fertilizer adjustment or, a seed rate or, those kinds of things, that kind of stuff is certainly eligible. But a small test plot is probably not going to reach the level of expense that it's worth going through the paperwork for. So if you're interested in this, Roger McGowan out of Kansas, he's with, oh shoot, I'm going to lose the name or the university he's with, but he has a really good article on it as well as Christine Tigran out of the Center of Ag Law and Taxation in Iowa. And they have both put in a lot of time and effort in researching this for farmers. And so I think if you're interested in that, those would be two really good resources to look for, both available on the web. So,
yeah, if you think of it, Tina, send us those links and
Yeah.
we could perhaps put those as references in our,
sure.
when we post all of this in our webinar archives. Thank you.
And Rogers with Washburn University, it just came in.
Yeah. Right. Okay.
Yep. Just whipped it. Okay. So again, this is a big change. I think it's going to be a small amount of people that this affects, but could be significant. The other thing about this, we just got a phone call yesterday from a promoter, and they were claiming that the One Big Beautiful Bill made this credit refundable, and they're incorrect in that. It is not refundable. You have to have tax, like income taxes owed, not even Social Security taxes. It has to be income taxes in order to get the benefit of this credit. So if you're not a high income taxpayer, this one's probably not going to help you out a lot either. So, so just pay attention to those ones. All right, another nice change for 2026 is that they finally increased the threshold for when you have to send somebody a 1099 for miscellaneous and NECs. This isn't going to affect interest or dividend or some of the other kinds of 1099s. But now, starting in 26, you don't have to report it until you've paid them more than $2,000. So don't get this confused. The 1099s that you're going to send in January of 26 have the $600 limit. The ones that you're going to send in January of 27 are where we can go up to the 2,000. So one more year, those lower thresholds, and then they're going to index that 2,000 for inflation every year. So it's not going to get stuck the way the 600 did. So, and then for the last couple of years, there's been lots of back and forth on the 1099Ks. it doesn't affect very many farmers, but or at least the farm income might be on the other side or a different venture. But that's like reporting from like PayPal and Venmo and things like that. They were trying to get that down to a $600, and everything was confusing because there's so much personal stuff, and how do we separate personal from business? So this bill just said scrap all of that. It's going back to, you're not going to get a 1099-K unless you have more than 200 transactions and it's more than 20,000 in payments. So kind of puts that back up. Now, it's also important to say that that doesn't mean that if you're receiving business income through PayPal or Venmo, that if you don't get a 1099-K, it's not taxable. That's not true. Still taxable, still have to report that income. And so we've got that. All right, couple things here, getting close. The Trump accounts are something new, and this is something that it's really confusing, and I think we might even see adjustments to this law before it becomes available. No contributions are going to be allowed before July 4th of 2026, so we've got a little time on this. They're kind of like an IRA, but they're not a Roth IRA, but they kind of act like a Roth IRA, and that's where a lot of the confusion comes from. These have to be established before a child. These are for kids. So it has to be established before the kid turns 18. They have to have a social security number. That was all over this bill. I didn't point it out on every provision, but just about every provision says that there has to be a social security number, to a valid one, to claim almost anything. But this is going to allow 5,000 a year to go in, index for inflation, and as a savings account to help encourage savings for kids. Employers, the only way that we can get this tax-free is if the employer contributes the money. I think this will be interesting for our farms who are set up as corporations and are paying the owners as employees. This might be a really great thing that we can start doing for their kids. But you do have to be, you can't discriminate on this. So if you've got employees with kids and you're paying yourself, then you're going to have to contribute for everybody. But if the employer does it, it's not considered part of gross income. And so it's actually a tax-free deduction for that. None of the earnings are going to be taxed until the money is distributed. So it kind of acts like a regular IRA there, but you didn't get a deduction for it on the way in. So only the earnings are going to be subject to tax when they come out. They listed very specifically how you can, all of it has to be invested in a diversified US index fund, or through a couple other sorts of things that are going to come out on an IRS approved list prior to July 4th of 2026. And once you put the money in there, you can't take it out until they reach 18. So it's really designed to just get some money saved for kids. The kind of cool part is that if you have a child born between 2025 and 2028, the federal government's going to throw $1,000 into this account for them. So the first thousands, I mean, and you can start it. It's not part of the 5,000. And if you don't open one for your kid and you file a tax return in 2026 with that kid on it and there's valid social security number, if you don't have an account open, then they're going to open one for you. You can opt out, but it's going to be, it looks like they're going to try and make it fairly automatic to get that open and started for those kids. A lot to learn on these ones. There's a lot of clarifications. So we'll see what comes of that. But again, not anything to get too super excited about because we can't do anything until next July. All right, another fairly interesting thing that they threw in is that we can now elect to spread the tax on the gain of a sale of farmland over 4 years. This doesn't mean that we spread it out over 4 years and use lower brackets. We calculate the tax today, but you can make 4 equal payments starting April 15th this year, or the due date of the return, and then April 15th the next 4 years. You have to sell to a qualified farmer. You have to have used that in your farming business. Or leased it to a qualified farmer for the last 10 years prior to the sale. And we have to attach to the tax return a covenant or other legally enforceable document that prohibits that property from being used as anything other than farm or farming purposes for the next 10 years. So lots of strings attached to this one. It's only good for land sales that occurred after July 4th of 2025. And it's not going to reduce the amount of tax that you owe in any way. So all you're really gaining is time value on the money. So if you invest that money and spread those payments out, um, you're going to get some interest off of it that you wouldn't otherwise. That's going to be really the only thing that's going to be beneficial. And if you miss a payment, so say you get into year 2 and you don't pay by April 15th and you pay March or May 1st, all of the other installments are due immediately. So again, interesting to know who wanted this and how often it'll get used, but there we are. All right. And then again, I kind of mentioned this before, but almost every individual provision that they put in here attached that you have to have a valid Social Security number in order to be eligible for that deduction or credit. It almost even looks like, and I'm just concerned, we'll see how what it's enforced as, but it almost looks like if you typo your Social Security number, it could disqualify you for a lot of these things. Now we have to, when we e-file a return, it automatically checks against the Social Security Administration to make sure that name and Social Security number match up. So I don't think that's going to be a problem for anybody that's e-filing, but anybody that maybe would be paper filing, that could be an issue. So. All right. That was all of it. We just snuck in under an hour, but I have time for questions if everybody else does. So.
Okay. Hey, thanks again, Tina. There was just a comment or question, I guess, relating back to I think the installment on the farmland tax thing. Will it not help a farmer wanting to buy a farm versus an investor? So I guess, yeah, if the requirement is that it needs to be sold to a qualified farmer, then yeah, you're kind of keeping out some of the investors. Is that how you take it a little bit, Tina?
Yeah, I think the thing that's hard is it's not going to change the tax liability for the seller.
Right.
So it's not like they're gaining a huge benefit. All they're gaining is that time value of money, which is not nothing. But it wouldn't be the same as even if we could spread that out over 4 years in 4 years brackets and maybe get a 20% capital gain limited to a 15% capital gain. Something like that, I think would encourage selling to a producer or another farmer. I don't know. I think the dollars would have to be really big to where this is going to be something that would be part of a decision-making factor. So.
Okay. All right. Any other questions? Go ahead and type in the Q&A and we'll try to watch for that here. Tina, I was just wondering, you mentioned the 19,000 annual gift exclusion. And is there provisions to up that over time? Do you know?
Yeah, that's always indexed for inflation. So I didn't check the 25 limit, but it would be out there. So if you just Google it, it'll know. But yeah, that one's already indexed for inflation and has been going up. It goes up in $1,000 increments whenever that hits. So.
Okay. So there is a question. Kid accounts max contribution is 5,000 per year, but if Fed gives $1,000, then max is 4,000. So I'm
Yeah,
not sure, you know.
yeah.
Okay.
So they're talking about the Trump accounts again. I
Yeah.
know for sure that if the employer puts 2,500 in, that counts towards the 5,000. I kind of think, and I would have to go back in the bill, and again, it's pretty confusing how they wrote this. I think the 1,000 can be that the feds are giving can be on top of the 5,000 that otherwise can be added. But again, we're gonna have to wait for IRS clarification on that one for sure.
Okay. And then there's a question on have capital gains changed at all?
Yeah, so no change this time. So we still keep those great rates. So anything that's in any income that would otherwise be in the 12 or 10% bracket is going to be at 0. So anything basically taxable income less than 100,000-ish is at 0. And then we go up to almost 500 at 15% and then 20 over that. So yeah, no change there other than the bracket levels indexing for inflation. So
Okay. All right. All right. So thank you. Okay. We are in a meeting here in Omaha, and someone referred to it, the bill, as OB3.
yeah,
So
maybe
that's kind there you
maybe
go,
that's what I'll
OB3.
start doing. Yeah.
All right. Kind of sounds like Star Wars, right?
Yep. It kind of felt like that reading it too. So
Okay. All right. Let's see. I think I don't see any other questions coming in right now. Let me just double check. I don't see anything. Okay. All right. So I think with that, we'll go ahead and we're up against our hour. So again, thank you everyone for joining us today. Recording of the webinar will be posted at cap.unl.edu, where you can also register for other upcoming webinars. Next Thursday at noon Central, we'll be hearing about the OB3 again, right? Dr. Brad Lubin will, with the Center for Ag Profitability, will explore policy changes to farm programs and implications of the Farm Bill. So you should see a short survey that comes up after you close out the webinar today, and we'd really, really value your feedback. Any comments you have are always very helpful to us as we do report our impact on what we're teaching and doing from our Center for Ag Profitability. So thanks again, everyone. Have a good day, and we'll see you again soon. Thanks, Tina.